No, I mean, you can't ignore the banks. It's the most important sector of the whole market. It's really foundational for everything. It drives the economy. So what happened starting last week is certainly very important. It's probably going to have some effect on psychology, if not actual underlying growth going forward. But I think if you kind of look back over the last few days between what was announced Sunday night with the new Fed facility, what was announced overnight with Credit Suisse, and then what was announced about an hour ago with the $30 billion deposit at First Republic, I think that's going to help to begin the repair process of rebuilding confidence in this group, helping to stabilize some of the stock price action, hopefully stem some of the outflows of deposits that you've been seeing out of certain other regional banks. So can't ignore it at all. It's certainly very positive. Today was a better rally in that it was a lot broader. You had more participation. It wasn't just tech. There definitely is a lot of people pouring money into tech, but it was a broader rally today, which is encouraging.
Yeah. Do you remain constructive at these levels? Because you've been on our show in recent weeks, but this was also before we had bank failures and all the maelstrom around that industry right now. Would you still be buying at these levels?
Yeah, I mean, you can't ignore what happened with banks. Like I said, it certainly is very important. I don't want to be Pollyannish and completely dismissive. I don't agree with the analogies to 2007, 2008, but I do think the disruption is enough, coupled with progress that you are seeing on the data front, certainly not as quickly as the Fed wants, but you are seeing movement on the data in the right direction. So that, coupled with what's occurred with banks, is going to help to alleviate the aggressive monetary tightening that you've seen from central banks. That's going to remove a big headwind. And you've also, I think, seen the highs for yields as well. And that removes another big headwind on for valuation. So I think it's now kind of gauging the growth reaction over the coming weeks and months, and then getting a sense for earnings, which, the earnings season kicks off in another couple of weeks, just to get a feeling for economic activity during this period of time, if it was, permanent damage or just kind of a blip that will get back on track.
So then what matters out of the Fed next week? Does it even particularly matter what the market is pricing in now? 25 basis points or nothing? Or is it more about where the terminal rate is and how long it takes to get there?
Yeah, I think the terminal rate question is going to be more important. I think the ECB today, they definitely have a very, very difficult choice to make in this environment where they don't have the benefit of benign inflation, and they also are dealing with all this market volatility. So I don't think the Fed can completely reverse itself, but certainly they can slow down the pace, stay at 25 basis points. And then, I think where there's a disconnect in the market right now is probably just on the aggressiveness of rate cuts. So, the market, as of 20 minutes ago, is pricing in a cycle ceiling of close to 4%, a little bit under 4%, and then, a little bit under 5%, and then pricing in about 80 basis points of cuts thereafter. So there are going to be a lot of moving pieces to the Fed next week, including the balance sheet. I think that's going to be a big topic of discussion. Do they slow the pace of quantitative tightening? Do they cut it off completely? And then the forward guidance that they provide around the cycle ceiling, like you said.
Yeah.
I think that's going to be the